What's up, everybody? This is Chang, and this is the unwritten rules of scaling into trades. A little bit of knowledge before you guys get started with scaling into trades. Scaling into trade requires experience. This is not something that anybody or inexperienced participants or new traders can do properly. It requires a little bit of understanding of how markets work. It requires understanding of how risk works. It requires understanding of how trends develop in the markets in order to execute scaling in the positionings properly so that you don't get burnt. So understanding trends in the markets, it's very important to understand how market profile works, especially if you're trading in an intraday basis, because when you're scaling into positions, you don't want to be scaling into positions into days where the market will have a reversal type days or scaling into positions on days where the market is sideways ranging. Typically, you want to see a very strong bull trend or bear trend being established in the markets in order to scale in properly. So another key thing of scaling in that is required is a proper understanding of risk. The reason being here is because when you scale into a position, oftentimes it's also called averaging into a position. If you're entering the market at say $10 on a particular stock or whatever, and the price of that stock goes up to $20 and you decide to add on another position, well, your new average price is at 15. So you basically have two open positions. You bought one at $10, one at $20. If the price that's currently trading at 20 decides to pull back to, let's say, $15, you're essentially breaking even on both of your positions, meaning that the first position that you bought at $10 is now up only $5, and the second position that you bought at $20 because the market pulled back to 15, now you are down $5 on that trade, and you're essentially at zero. So a proper understanding of risk and averaging of position and averaging of prices is required to scale in properly. And the last thing that is required to understand is the proper time frame that you're trading in. A lot of times we can pull up a chart and look at 30 minutes, 4 hours time frame, and we can see a nice trend being established over the next several months. But if we are not positioned to swing trade over the next several months, then it was not appropriate time frame for scaling into positions. However, if you do want to set up trades such as swing trades over a several month time frame, then you have to take into account things such as like swap fees if you're trading in the forex market. You have to take into account overnight margins if you're trading in the futures, expiration dates if you're trading in the futures. If you're trading stocks or whatnot, you probably need more capital or additional capital to open new positions as you're on side on the trade. So these are just some of the things that are required. Now let's talk about some of the mistakes that new traders make when scaling into positions. So, common mistakes that people make when they scale into positions. So, the first one being is no trade setup. So, when scaling into a position, you don't want to use arbitrary numbers to scale into a position. For example, every 25 cents or every 25 pips or every 25 ticks, you're going to add on another position. That's a bad way to scale into position using arbitrary numbers because as the markets go up and down and they pull back in prices, you may be caught offside. So always have a proper trade setup before you scale into a position. The second common mistake that a lot of people make is that they scale in too quickly. So as any markets go, sometimes a market goes, moves up parabolically very fast, and then you're just entering the market, and you're scaling in too fast. And then what happens when the markets pull back, or you experience something like this taking place in the markets? And you're scaling in, scaling in, scaling in, scaling in, scaling in, and then as the markets pull back here, all of these positions that you've added here will now essentially equate to breaking even or possibly even a loss on your position. So you never want to be scaling in a market too quickly. You want to wait for trade setups, technical setups, price action to align so that you can add on new positions. And lastly, you want to have proper position sizing. You don't want to size your positions too large. Another common mistake that quite a bit of people make is that when they scale into a position, they typically add the same amount that they started with, or sometimes even more. And what happens is that your top positions or your top side becomes too heavy. And as the markets pull back, you're putting yourself at additional risk to being offside or having bad risk management when you're getting yourself into a trade like that. So, the next thing we want to talk about is proper scaling of positioning. So, having an open position that's in profit is very important for when you want to scale into a position. Why is that? It's because having a position that's in profit already before you enter your second or third position allows you a nice buffer zone or a nice cushion so that in the event the markets pull back on your new position entering, that you have essentially a buffer zone to absorb some of the pullbacks for when you're getting into a new position. Next thing you want to do is you want to ensure that your position size is smaller than your initial position. So a great technique to do is to ensure that when you get in here, let's say you entering in here at the bottom, you want to enter, if you're trading stocks, let's say you want to enter your initial is 200 shares. When you get up to a position like somewhere around here, you want to add on at least half or less of your position size there. So now you have 300 shares, but then you're waiting for the markets to pull back. And then lastly, you want to ensure that you have a valid trade setup, because you can see here in the first initial trade, as our $200 position is on side, recouping all of this move up here, we've added another $100 at the top here. Now our average position is $300 and our average entry price is roughly around here. But as the markets pull back, our first initial position recouped about $200 in profits from this move right here, while our next position that we've added, the $100 lost about here. But because we gained here and lost a little bit here, our position is still on side. And as the markets continue to go up, we can look at scaling into more positions as it goes up. So finally, here is an example of the S&P 500 chart, and we can take a look at this chart and ascertain a lot of information from this chart and talk about how we can use something like this to properly scale in and out of position sizing. So several key things we can take note of here is that when we want to enter a position, we always look for where has the market leveled off, right? And as you can see here, the market is beginning to teeter off, and the break of this level right here essentially signals that the market is starting to go downwards. If you're aggressive, you can enter in position here. If not, another good trade to do is to wait for the markets to pull back up here, and then this is where we would enter our first position size. We would go in here, enter the markets right here, and then as the market is trading down, we coop all of this move. And as the markets begin to consolidate around here, this is where we can go back in and we can enter in our second position here, ensuring that our second position is smaller than the first. So let's say here, for example's sake, we added 300 shares. Over here, we scale in, but going in smaller than our initial position. And as the market is trading down, we can begin to see that our positions begins to make money on it. And as the markets pull back up again here, we can take a look and see whether or not this is going to revert back or continue to follow this trend. As you can see in this particular area here, when you see strong selling coming down, this is when you want to add another position around here. As the markets continue to come back down, we add another position, again smaller than the previous, and as the markets go back down, this is when we can start looking at exiting our position. Always using a level to exit our position. And the level we see back here was the level from the previous day. This was the intraday low of the previous day. And so this acts as a very nice level for us to set our profit targets. But as you can see here in this example, when the markets pull back, as we scale in, because we're adding smaller positions as we scale in, we essentially protect ourselves when the markets pull back up too aggressively. So I hope you guys enjoyed this video, and I'll talk to you guys next time. Bye.